If you watched my last video where I talked about who benefited from the silver crash, then you already know Friday wasn't just another volatile trading session. But today, we're going further, because new data has come out. COMEX delivery reports have been updated, and what they reveal removes any remaining ambiguity about who benefited, how they benefited, and why silver had to be smashed when it was. This wasn't random, it wasn't panic, and it definitely wasn't retail profit-taking. What we're going to walk through today is how JPMorgan exited silver shorts at the exact bottom of the crash, how that exit was enabled by exchange mechanics, and why the CME's actions on Friday now look less like risk management and more like systemic triage. And before we even get into JPMorgan or COMEX, there's one more development you need to know about. Because early Sunday morning, while Western markets were closed, India's MCX exchange held a special trading session, and silver didn't stabilize. It reacted violently. That matters because India is not a paper-driven silver market. It's physical, it's price-sensitive, and it's often the first place stress shows up after Western paper suppression events. That Sunday session sent a clear message. Friday's crash didn't resolve anything. It displaced it, which brings us to the real question. If Friday was supposed to reset risk, why is the rest of the world still flashing warning signals? Today's video has three goals: to show you exactly how JPMorgan benefited from the crash, to explain how CME and COMEX mechanics made that possible, and to explain why this sets up a potential boomerang move, which could easily push silver above $200 in the blink of an eye. Let's start with JPMorgan, because the timing here is everything. According to COMEX data and delivery reports released after Friday's session, JPMorgan closed a significant portion of its silver short exposure at approximately $78 per ounce. Let's anchor the numbers. Silver peaked near $121 earlier in the week. It collapsed to an intraday low around $74, and it settled right around $78. That settlement level matters, because that's where JPMorgan closed its shorts. Not before the crash, not during the slide. At the bottom, that alone should stop you. Now add this. As of December 2nd, 2025, U.S. banks were net short 17,838 silver futures contracts, roughly 89 million ounces. At $121 silver, that's over $10.8 billion in short notional exposure. At $78, that exposure is dramatically reduced. This is textbook leverage management, the same playbook seen repeatedly in highly levered markets. Price is allowed to rise enough to pull in leverage. Liquidity thins, paper is dumped aggressively, stops are triggered, long liquidation cascades. And shorts cover into forced selling that's not theory. That's structure. Now let's talk delivery, because this is where it gets uncomfortable. On Friday alone, 2,514 February 2026 silver contracts issued delivery notices. That's 12.5 million ounces in what is typically a low delivery month, and here's the critical detail. JPMorgan was the short bank on all 633 delivery notices issued that day. Every one, which means JPMorgan didn't just close shorts. They did so into a delivery window at a post-smash settlement price of $78.29, and then immediately reduced exposure before delivery risk escalated. This is exactly what we discussed in the previous video. How delivery pressure disappears after chaos. Except now we have the name, the timing, and the price level. This isn't conspiracy, it's alignment. And it raises a brutal question for stackers. If JPMorgan can exit billions in exposure precisely when longs are being margin called, then what does price discovery even mean in this market? Now, let's talk about the exchange. Because JPMorgan could not have done this without the CME's structure cooperating. On Friday, COMEX traded an estimated 1.842 billion paper ounces of silver. Let that sink in. That's more than double annual global mine supply and more than total annual silver consumption. In a single session, this wasn't trading. It was compression. At the same time, CME raised silver margins from 11% to 15%, gold from 6% to 8% as, because margin hikes don't punish entities sitting on warehouse metal or balance sheet access. They punish leveraged longs, hedgers, speculators who don't have unlimited liquidity, and when margin calls hit into thin liquidity, price doesn't fall smoothly. It gaps. Now here's where things get even more concerning. Multiple market participants noted that COMEX circuit breakers, designed to halt trading after extreme moves, were effectively bypassed during the most violent portion of the sell-off. The result? A controlled vacuum where paper supply explodes, physical pricing in Asia remains $40 plus higher, and delivery risk is quietly neutralized. This is why Shanghai, India, and Tokyo didn't confirm the Western price action. And this is why India's MCX reacted the way it did on Sunday, because physical markets are now responding after the paper reset. Which brings us to the uncomfortable conclusion. If COMEX truly had sufficient metal to deliver, if risk was genuinely balanced, if this was just profit-taking, then none of this choreography would have been necessary. Instead, what we saw was desperation disguised as volatility control, and desperation tends to boomerang. Now let's talk about what happened while most Western markets were asleep. Early Sunday local time, India's MCX opened a special trading session, rare and usually reserved for stress events. Silver traded around $91 per ounce, including India's 6% import duty. Strip that out. Backhand index pointing right, that's roughly $85 silver, the same level COMEX closed at. But here's the real bombshell. MCX margin requirements were reportedly pushed above 60 to 65%. That is not risk management. That is forced liquidation territory. Indian brokers immediately began issuing margin calls. The market is long heavy. Contango steepened. Meaning, this selling is not voluntary conviction. Doesn't matter positions are being closed because they must be, and this matters for Monday, because stress doesn't stay regional, it migrates, especially when the same metal is being traded across interconnected exchanges. COMEX raised margins. MCX raised margins even more. That's not calming markets. That's squeezing them from both sides. Now, to bring some structure into the chaos, I want to reference analysis from Clive Thompson's latest video, where he steps back and asks the right question. How abnormal was this, really? He points out, gold was up 66% in 2025, silver up 135%. The rally into January was parabolic and Friday wasn't a pullback. It was a violent unwinding of one of the most crowded trades in the market. He also explains something critical. Stop losses and leverage don't create smooth declines. They create air pockets. And after reviewing decades of data, Thompson shows gold crashes of this size are extremely rare, but historically more likely to recover than not. Silver crashes are frequent, and 2/3 of the time, silver recovers strongly, often exceeding the prior highs.
First, let's get a handle on the scale of this collapse. As you can see on the chart, looking at the gold price, the rally was nothing short of parabolic. In 2025, gold surged 66%, and silver was up an incredible 135%. Then, just before the crash, gold was flirting with $5,600, and silver had soared past $120. And then the floor gave way. Let's have a look at the damage which was done on Friday, January 30th, yesterday. So here we see the very, very large drops in prices of the futures, 31% silver, 11% gold, platinum 18%, and palladium down 9%. And the spot prices were also down very, very sharply. Now moving on, this obviously wasn't a minor correction. It was a violent unwinding of one of the most crowded trades in the market. The ETFs that track these metals also fell and felt the full force of the blow. The popular iShares Silver Trust, the symbol is SLV, lost 31% of its value, even more than the spot price of silver. And again, don't take that as being representative of the net asset value. Things were moving so fast, it may be above or below the net asset value of those shares at the moment. We'll find out on Monday as prices, well, we don't know. Prices are probably going to move very fast on Monday, one way or the other. So I'm not going to say which direction, other than I'll tell you what I think in a minute. But we'll get to that. But another one which really, really hurt was the ProShares Ultra Silver Fund. That cratered by over 62%. So beware of leveraged funds. They can move far further and far faster than you can imagine. It was one of the worst days on record for both. So what happened? Why did the market suddenly panic and sell all its gold and silver? Well, President Trump announced his nomination of the next chair for the Federal Reserve. His name is Kevin Warsh. He was a former governor, and he has been seen as a sound money person because of the fact in 2011 he resigned from the Federal Reserve. Why? Because he didn't agree with the quantitative easing, QE2 it was known as at the time, and he felt that this would be inflationary. So you can see based on that, a lot of people see him as a hard money man. But I think you're going to find out a lot more this weekend and on Monday, because looking at some of the things he's said since, my conclusion, and I won't go into too many details here, but my conclusion is that he's a person who tends to follow whoever is in power at the time, and he has made some statements which you can read about if you Google it, but they make me think that he's not at all going to be hawkish, but rather could well be very dovish and support lowering of interest rates, something which even President Trump has said he expects that he will be lowering rates. Trump says he agrees with him that rates should go lower. But that's not how the market saw it on Friday, because they didn't know that. They perhaps hadn't got time to read up on him. But I think you're going to find out that that view that they are employing somebody who is going to defend the Federal Reserve, as was seen back in 2011, defend the independence of the Federal Reserve, perhaps it's not all that it seemed at first sight. That's just my opinion. We'll see what the papers and TV channels make of it over the weekend. Anyway, his appointment had an immediate and powerful effect on the US dollar. Let's have a look at that now and see what happened to the US dollar. So I'm going to bring up the DXY. The DXY is an index of a basket of currencies. Now, last year, I'll have to just make that fit on the graph here, auto fit. Last year, the DXY, that's the dollar index, fell by about 10%. There we are, from there to there on that red line. And it started falling just the last few days until yesterday, when we heard about the appointment of Kevin Warsh, and the dollar rallied about 1%. Now, a stronger dollar means it will cost foreigners more to buy gold, so it's a contributory factor perhaps in gold's fall. But of course, what was really going on in the fall was, as it started to plummet, it triggered stop losses. Stop losses are where someone has said, I'll buy some gold, but if it falls below a certain level, I want this to be automatically sold. Do not consult me, just do it. That's a stop loss. So if it touches a certain price, the gold is automatically sold at the next price. It doesn't mean to say you get the price of your stop loss. You get the next price after that stop loss, which could be 5 cents lower, it could be 10 cents lower, it could be $1 lower, it could be $5 lower. I personally would never recommend anyone to put a stop loss, but the whole world is full of people who have leveraged bets. They borrowed or betting 10 times as much money as they've got, and they know they could lose it all, but to make sure they don't lose more than they've got, they have what's called a stop loss. So if the price falls beyond a certain point, they're auto sold, ensuring that maybe they don't have anything left, but they haven't lost more than they had to start with.
Clive dismantles the simplistic narrative that Friday was merely about a hawkish Fed shock. Yes, Kevin Warsh's nomination acted as the spark, but sparks don't cause explosions unless there's already gas in the room. The dollar's knee-jerk rally added pressure, but it was never the real driver. The real accelerant was the sheer density of leverage positioning sitting just beneath key price levels. Once those levels were breached, stop losses fired automatically, regardless of price, liquidity, or logic. And because stop losses don't execute at their trigger price, but at the next available price, each wave of selling pushed the market lower, triggering the next wave in a cascading effect. This is why Clive's warning about leveraged funds is so important. Leverage doesn't just magnify gains, it compresses time. What would normally take weeks of repricing happened in hours. And when markets move faster than human decision-making, control shifts from investors to algorithms, clearinghouses, and margin clerks. That's when exchanges step in, margins rise, and the plumbing of the market, not fundamentals, dictates outcomes. But once the dust settles, the critical question isn't why the crash happened. It's what typically happens after crashes of this magnitude. And that's exactly what Clive turns to next.
So for gold, a single day crash of 5% or more is an incredibly rare event. In the 25 years of data that I could look at, it only happened about 10 times. This tells us that gold is, relatively speaking, a far more stable asset than its volatile cousin silver. Let's just have a quick look at how that did. So I'm going to go over here and bring up there we are. This is gold, and I'm looking at what happened 7 days after a 5% crash, 31 days after a 5% crash, or 1 year after a 5% crash. The reason these figures don't all add up to 9 is in one occasion the difference was actually 0%. But what we see is after 1 year, there were 3 times as much probability, 3 out of 4 probability that the price would rise. I've gone to the wrong sheet here. Let's go back to that. There we are. Now that's only 6 versus 2, so 6 rises or 2 falls. It's not a huge and statistically significant number, but it does tell us that historically it was more likely to rise after a 5% crash than fall, and on average gold was up 13.99% 1 year later, more than recovering the fall. But of course you had to be patient to get that. So whilst the market after a crash in gold was more likely to go up than down, the rebounds were not as dramatic as one might expect. 1 year after the 5% crash, gold when it went up was up about 38%. But if we take into account the losses, it would have been on average up 9.34% if you take the loss years as well as the positive years. But silver is rather different. Silver tells us a completely different story. A 5% or greater single-day crash is not an anomaly, it's a regular feature of the market. Since 2000, the year 2000, silver has experienced 96 crashes of 5% or more. So those who are in silver have had a stomach-churning time over the years, most of which they've forgotten, but on 96 occasions they've seen 5% falls in silver or greater. And of course, yesterday was probably greater than any of those falls ever. Let's see how silver performed after those 96 crashes. And I'll bring that up here, where we were on it, sorry. Yeah, there we were on it. So, by the way, these figures don't always add up to 96 because some of the returns after 1 year were 0, so they're neither positive nor negative. But we see that after 1 year, after a crash of 5% or more, silver was up 56 times and it was down 32 times. And the average gain for the up moves was 38%, obviously clearly exceeding the size of the fall. So silver definitely was a much more volatile asset and generally recovered, not always, because there were like 1 out of 3 chances that it would fall, but 2 out of 3 times it recovered and recovered very, very strongly. So the pattern is clear. The longer you hold on after a silver crash, or for that matter a gold crash, or for that matter a stock market crash, the higher the probability of a positive return, and the longer you hold on, the more powerful that return is likely to be. Let's put it another way. It's always a good move to buy after, or not always, it's more likely to be a good move to be a buyer after the crash, because quite often the crash represents a situation where the metal has been oversold. So 1 year later, after a crash, silver was up 64% of the time, with the average up move being 38% after the crash.
Now here's the part Wall Street doesn't want emphasized. Despite everything, open interest only fell modestly, physical spreads widened, and trust in paper pricing took another hit. Tether now holds more gold than most central banks, accumulating 143 tons, worth $24 billion. Asian physical markets remain tight, and banks just showed the world how desperate they are to manage exposure. One analyst put it perfectly. They didn't fix the problem. They revealed it. You don't smash a market like this unless the pressure underneath is worse than what people see on the surface. Cheap paper, tight physical, and a public increasingly aware of the difference. That's how boomerangs are built. So let's tie this together. Friday wasn't just a bad day. It was a leverage flush, a delivery reset, a margin-induced liquidation, and a message from the system that it's under strain. JPMorgan appears to have exited risk at the exact moment pain peaked. CME provided the conditions. India just confirmed the stress isn't over. If you're a silver stacker, your anger is justified, but so is your conviction. This wasn't the end of the story. It was a chapter transition. If this helped you see through the fog, like the video, share it with someone still confused about Friday, subscribe for real-time breakdowns, not headline narratives, and most importantly, drop a comment. What do you think mattered most here? JPM's timing, CME's margins, or India's warning shot? Because the next move won't happen quietly, and we'll be watching it together. Thanks for watching.